There's a 529 plan move that lets a parent drop $90,000 into a single contribution, completely tax-free. And if the kid never spends a dollar of it on college, convert the leftover into a Roth IRA worth decades of tax-free growth. Completely legally. And your financial advisor has probably never said a word about either half of that sentence. Most people think they know what a 529 is. Tax-advantaged college savings. Money in grows, comes out for tuition. Clean, simple, and honestly. That version is fine. It's just the stripped-down version, the middle-class version, what the wealthy have been running in a completely different gear for years while everyone else guesses at the rules. Here's the reality. The average American family puts roughly $2,500 a year into a 529. A family that knows the rules can deposit $180,000 in a single afternoon, and the IRS allows every dollar of it. The difference isn't income, it's information. And for the people who control that information, estate attorneys, private wealth advisors, there's very little incentive to hand it down. Because the 529 has two hidden gears, and almost no one shifts into them. The first is called superfunding, and this is where it gets interesting. Every year, the IRS lets you give someone up to $18,000 as a gift without triggering the gift tax. Per person per year. But the 529 has a special election built into the tax code, Section 529, that lets you front-load 5 full years of those annual gifts into a single contribution. Right now, all at once. That's $90,000 per parent per child in one deposit. If you're married, both of you can do it. That's $180,000 into a 529 in a single year, completely clear of the gift tax. No annual gifting schedule, no spreading it out. One move, 5 years of exemptions claimed simultaneously. And that $180,000 starts compounding immediately, market-linked, tax-free. You just handed your child a 20-year head start on $180,000, and the IRS built the rule that makes it possible. But here's where it gets interesting. What if your kid gets a scholarship, skips college, uses half the account and stops? For years, the fear was leftover money is trapped. Pull it out and you owe income tax plus a 10% penalty on the earnings. That story kept a lot of people from maxing these accounts. It was never the complete story. In 2022, Congress passed the Secure II Act. Buried inside that legislation, in language most advisors still haven't worked through, was a provision that changed the entire calculus. Starting in 2024, a 529 account that has been open for at least 15 years can roll unused funds directly into a Roth IRA in the beneficiary's name. No taxes, no penalty. There are guardrails. The annual rollover is capped at the standard Roth contribution limit, $7,000 right now. The lifetime maximum is $35,000. The account has to be 15 years old, and contributions from the last 5 years don't qualify. These are real rules. But $35,000 seeded into a Roth IRA at 22, left alone until retirement at historical market averages. That number can exceed $1 million, tax-free, for money that started as college savings nobody spent. The 529 was never just a college account. It is a dual-purpose wealth vehicle with a college default, and most people only know about the default. The families running this play aren't doing anything aggressive. They opened a 529 15 years ago. They superfunded it early, let it compound. Now they have 2 exits, pay for school or quietly hand a young adult a retirement nest egg at 22. Either outcome wins. That's the move the middle class was never taught, not because it's complicated, but because nobody with a financial incentive ever sat down and explained it. Your school never covered this. Your HR orientation skipped it. And the advisor who set up your 401k doesn't get paid when you open a 529 and leave it alone for 15 years. Here's the catch that isn't really a catch. The IRS knew you could do this. They wrote the provision. They set the 15-year clock deliberately. This is not a loophole you're sneaking through. It's a door they left open. The question is whether you knew the door was there. Start the clock early. Open the account before the child is born if the capital is available. Superfund it on day 1. Then watch what 2 decades of compounding does to a number that never has to touch a tuition bill. And here's what's still unresolved. If a 529 open today can silently transform into a retirement account in 15 years, what other tax code vehicles are quietly changing shape right now, while most people assume they already know exactly what they are? That's the next file.